Hey guys, welcome back to another video on Sunday with EDGI, episode 8. This time it's all about big oil because big oil seems to be back. What you can expect in this video is a brief overview of the headlines regarding news of the big oil companies because most of them have been reporting their earnings last week. But after that I will go into a quick brief evaluation of the 5 oil majors: ExxonMobil, Chevron, BP, Shell and Total. So why I'm doing this? Well, the headlines were really good last week based on the earnings reports, and I own a lot of oil stocks. It's probably from a sector point of view one of the biggest sectors in my portfolio, and I just want to make sure that my money is safe there. But please be aware, I am not a financial analyst in the oil and gas sector, hence I might make some mistakes here. I did a lot of data scraping, I might make some misinterpretations. But hey, as an individual investor, a retail investor, an amateur investor, this is how you will see later in this video how I analyze oil stocks. So, hey, get your coffee and let's get started. So let's just have a look into the headline numbers then, because look at this: ExxonMobil, Q2 earnings beat on huge demand recovery. Then let's go to Shell. Oil giant Shell raises dividend and launches $2 billion share buyback as commodity prices soar. They increased their dividends with 38%. Amazing. And we know they come from a 66% dividend cut, but to see such a recovery in dividends so quickly, it really surprised me. And it of course makes me happy as an investor. But also France TotalEnergies to buy back shares as fuel prices boom. They want to buy back up to 1 billion, but also they had great numbers. Chevron as well, also again beating estimates. I mean, these are really huge numbers. We will soon go through some of them. BP hasn't reported their numbers yet. They will come, I believe, on Tuesday. But hey, it should come as no surprise because last year the numbers were really low. We even saw a negative price in oil last year for I think for a day. But you know, for me, everything above 70 is the same as a barrel price from 6-7 years ago at 100, because the companies have been becoming so much more lean in their production that they are not having anymore a cost per barrel of 60. It's rather around the 40 at the moment. So, you know, there's so much margin improvement on these barrels. So at current prices, it's no wonder that oil is doing really well. And we can see that as well. If you look just at the crude oil prices, this is what I mentioned to you last year. Around 19 April, it hit rock bottom at the time. But if you now look at the crude prices, they are all the way up again and on a let's say on a 2-year high at the moment, trading around $70 at the moment. So if you look at this and then you compare the share price development as well, if we take around August last year, or let's say this time last year till now, you can see also that the companies didn't really perform as per the oil price. So the oil price rebounded much more quicker than the share prices did. So does it mean that the market is expecting the oil price to come down again anytime soon? Hey, I don't know. I really don't know. I think that the oil price is there to stay around probably $60 for the upcoming time. If nothing awkward happens like in 2016 that suddenly Saudi Arabia starts to do a price war. But until then, I think we'll see around $60 for, based on all the economic recoveries and such. What you can also see here is that Royal Dutch Shell has been really underperforming compared to the others. I think this has to do a lot with the dividend cut from last year. It really led into a sharp decline. But as you can see here that, for instance, ExxonMobil recovered much more better since then. Having said that, I think there's still some potential here, just looking at the price chart. But you know, we are long-term investors and fundamental investors, so actually price charts doesn't tell us anything other than a little bit of historical context. What is probably more important here is like how did the oil majors really get their prices down and beef up their cash flow? And this is a little bit concerning if you think about it towards the future. Their capital expenditures has been really been cut almost in half over the last decade, which really means is that they are not building a lot of new assets. This also usually means that there is less oil supply coming in, and this can really create an imbalance into the market in the future, which actually could also result again in really high oil prices. I know that many people, and probably also some of you might think like, hey, but what about renewable energy? Guys, this still takes time. The world is still so much depending on oil, at least for the next decade. We can expect still a lot of oil consumption, and it's still intending to grow. I read through some of the reports. They're still seeing growth in the upcoming years in oil demand. But if we then look at, for instance, the oil reserves, replacements and the let's say the reserve life of oil. In the past, it was almost like 40 years in the 1900s. It dropped quite quickly in the 1930s to 15 years. But now it's really been dropping to more than below 10. And this is an issue because if you look at Shell, for instance, here you see the last decade, there was a reserve life of 12 years. Now there's just around, 8 years, according to this graph. So I will go soon into this, but the reserve life is a really important metric for the oil industry and also the oil majors, because effectively it means that the current proven reserves that they have, proof reserves, are empty if they keep on production in another 8 years like this. They will be out of it. So they need to replace their oil reserves by investing in new exploration, investing in the building of new assets, of new oil rigs and platforms. That's how they replace it. And for this, it needs CapEx. And as you could see, CapEx was going down. So having this context of still increasing demand in the upcoming years for oil itself, also knowing that CapEx has been reduced over the last, let's say, decade by the main oil majors, also knowing that their cost of operations and cost of productions has reduced, which increases the margin and therefore doesn't require them to have such a high oil price anymore. But at the same time, also reduction of the reserve life is giving really interesting dynamics, meaning if demand keeps increasing and reserve life is not being extended and hard to replace due to the lack of capital investments, we might see some really awkward oil prices in the upcoming years. Companies will do well with that on the short term, but I do hope that if this happens, that the companies at least start to replace and invest again properly. Having said that, some of these companies, like Shell and Total, are on purpose not replacing so much reserve because they have been shifting their capital expenditures towards new energies. And this is really important also to look at, because there's generally a need in society also compared to when you think about the climate agreements from Paris, there's also a need to come to more sustainable energy sources. And some companies started investing in that. And that's why you also see a shift in CapEx towards other energy resources, but they don't contribute to the reserve life figures. Okay, so let's have a look at the 5 big oil majors. Okay, so what's important to know, for some of those figures, I use the latest annual report of 2020, but for the others, the latest second quarter earnings report, except for BP because it's still to be released. So please keep that in consideration when I'm running through the numbers. So let's have some of the first numbers. The trailing 12 months price to earnings is utterly useless to look at the moment when we talk about these oil majors. It's just like if they had negative earnings last year because of the big downturn during the pandemic, we cannot really look at it because these are negative earnings. But the first back on the napkin valuation that I like is the price to book value. It shows effectively how much the assets are currently priced at. So you take the assets from the balance sheet, you look at the share price, divide that with each other, and you get a ratio. What you can see here is that ExxonMobil is one of the most expensive price stocks based on their book value. If you look at the European oil majors, they're all around book value. If you go to Warren Buffett in the past, how he evaluated, these are considered then really attractively valued companies at the moment, specifically Royal Dutch Shell. But what many companies are really proud on and really communicating a lot is their debt level. So what I've done, and this took me really lots of work, what I've done is I looked at the net debt, which is the short-term liabilities and capital leases, plus the long-term debt and capital leases, minus their cash and debt, divided by the total equity. So if you think about this, this is what they call gearing at Royal Dutch Shell and, for instance, BP, and it shows a lot about how their balance sheet is looking at. Disclaimer here, Royal Dutch Shell includes the capital leases into the gearing number, BP not. So if you would go to BP, they will probably communicate that they have around a 25% gearing. But if you compare that with Shell, it wouldn't be fair. So what I've done here, I used everywhere the same, the same metric using the same calculation, and this is the outcome. So based on that, we can see that Chevron has the best balance sheet in the industry at the moment, slightly, or actually far followed by TotalEnergies, and then by ExxonMobil, Royal Dutch Shell, and BP. And we know that Royal Dutch Shell really came from a 33% gearing. Last quarter, they reduced, I think, their debt with 7 billion, which got it on this level. So the trend is really good at Royal Dutch Shell at the moment when it comes to debt pay down. But this is how it looks like. So from a balance sheet point of view, Chevron looks really, really good. Another metrics that I tried to look at, which was not easy to find, were the cost per barrel and the average realized oil price. This took me a lot of searching, and actually the numbers, I don't find them so reliable, but you could say that on average, it's around, let's say, $40. Some companies a little bit lower, some companies a little bit higher. I actually don't know if these are really comparable numbers, if there are some other expenses in there or not. But just for an overview, to give you a feeling that if companies are operating at a $70 barrel price, that they are making between $20 to $25 profit on top of that. Good for you to know. I think it was TotalEnergies that said that if the oil price increases with $10, it gives them $2.5 billion in excess cash flow. So I think these are probably good numbers to consider. Hard to analyze this, but this is what I was able to find. Another one that I really like to look at is, I just spoke about CapEx and how much CapEx is being invested for building new capability to produce oil. I would say that the oil majors are all around the same level. We need to see what BP will report in the second quarter. Maybe it comes down a little bit, because if their OPEX was low and the CAPEX was similar, then the investments might look a little bit skewed. But you could safely say that the companies are reinvesting approximately 50% of their operational cash flow back into future production capabilities, or in some cases, renewable energies. I think this is good. I would always love to see more than 30% invested of operational cash flow, because less than that you can really start doubting about if the company is having enough earnings power in the future. So then if we look at the proved oil gas reserves, so how many gas reserves in barrel of oil and equivalent they currently have, you can see here, and this was a surprise to me, that BP by far has the most oil reserves, almost 18 billion. Shell almost has half of that. Well, it's good to know Shell did a really, really big write-off 1 or 2 quarters ago on their reserves. ExxonMobil, BP, and others not necessarily have done that yet. I know they did some write-offs, but not to the extent of Royal Dutch Shell. So keep this into consideration. But I was not aware that BP has one of the biggest reserves, or has the biggest oil reserves in the world. I thought always it was ExxonMobil or Chevron. But so this was really insightful for me to see. If we then look at the oil and gas production on an annual basis, you can see that Shell, however, is a bigger producer on a daily basis than BP. So while BP has a lot of reserves, they are not necessarily also producing twice as much on a daily basis. So you could argue that if they would invest more in production capacity, that they could beef up their cash flow even more. And with these oil prices, I think there's definitely a business case for that. Question is, of course, if it takes 7 years to bring an oil platform online, whether they can realistically have $50 to $60 of oil as an average price 7 years from now. So that's of course always the question mark. But these two figures are really important because we are now going to look at the reserve life, and you calculate that by dividing the oil gas production on an annual basis in billion barrels by their reserves. And this is a really interesting statistic because now you can see that Shell has just 7.4 years left of oil reserves. Keep that in mind. Compared to BP, it's 15 years. So Shell really needs to do two things. Either increase their capex and bring new oil online and or let's say more exploration so that they find more so that they can build it, or they need to really quickly in the upcoming years do a lot of acquisitions, I guess, in renewable energies. The question remains then, is this as profitable as it currently is with oil? So this is a big question mark. It concerns me here a little bit in Shell. When I saw these numbers, I was not aware of it, that they have the lowest in their peer group. It's something they really need to work on, because I'm not sure that in 7 years from now we will be at that level that Shell will find it easy to easy to replace the cash flows actually. So probably they need to continue paying down debt otherwise, and look at other acquisitions where they can replace some of the oil reserves. When we look at the reserve replacement, I couldn't really find those numbers. So the reserve replacement is how much new oil do they discover and prove, and how much new proven reserves they are adding in a year, compared to how much they have been producing. Only Chevron was clear about that, and they replaced 74% annual from the oil. And over the last 5 years, they had an average from 100%. Shell had probably less. So just keep this in mind as well, that I expect the reserve life for all these companies generally to decline due to the lack of capital investments and exploration. So these are some of the key metrics that I find important to compare as a peer group. What I would like to do now is look a little bit into their cash flows. So if we look at the free cash flow statements here, what is really interesting to see is that Shell has actually one of the highest cash flows. But what I want you to make aware of, some of these OPEX numbers are quite skewed, because Chevron looks low, but I know that on a forward basis it will be rather around 23-24 billion going forward. What it shows here also is that there were quite some write-offs that influenced the OPEX. But nevertheless, generally Shell is one of the best cash flow generating companies out of the 5 oil majors, even if you look at it from a historical perspective over the last 6-7 years. Chevron, as you can see, has some work to do in the free cash flow, but also BP. I expect more from BP going forward. Yes, they are still investing a lot, and as you can see actually here, Shell is one of the biggest investors, but probably you can see here therefore also kind of the correlation between their reserve life and the investments that they need. So they just need to invest way more than other companies to feel comfortable into the future. So cash flows look in general quite good. I expect BP's one to probably increase to 10 billion or so with the latest quarter. I expect them to have an additional free cash flow of 3 or 4 billion, and last year it was in the minus in Q2. So keep that into consideration. If we then look at how they are using this cash flow, from a dividend point of view, this is a bit scary. Even with these good numbers from ExxonMobil in the last quarter, they are paying out all their cash already when it comes to the dividends. The same for Chevron. What you can see now here is that Total and Royal Dutch Shell are way more conservative. And you can also see how the dividend cut has really helped Shell to clean up the balance sheet, because what they have been doing is also reducing their debt a lot. Now, the net debt reduction here looks a little bit awkward, but what happened to Chevron? They effectively borrowed another 22 billion in Q1 last year, in 2020. Some of that got repaid again by 9 billion. It was not done out of cash flow. Yeah, it was just done out of the additional cash they had at the time. Chevron was actually adding debt over the last year as well. They had also to finance some other stuff still, and also increased a little bit their cash right then. But Shell has been really a net company that has been paying down a lot of debt. Dividend is really safe at the moment. Question is if they can sustain this free cash flow. I think it will rather go to the 13 billion, overall 13, 14 billion if you take those one-offs. And in that case, you will probably see around 40% payout ratio, which I think is really, really healthy and safe if we think about that. TotalEnergies also has not been increasing the dividends over the last year, but also in this case, I believe that their payout ratio is really comfortable. I expect BP's payout ratio after the 50% cut from last year heavily to improve with the Q2 numbers, and rather also go to the 50-60% payout. So what you can see here is that the European majors have a pretty prudent dividend payout policy at the moment, after BP and Shell have reset their dividends and TotalEnergies effectively just not improved it over the last 5-6 years, while ExxonMobil and Chevron really have the water at their lips, and they really need to watch out, and we will see probably less flexibility there. So taking that into account as well, the level of payout, I would like to now go a little bit to valuation. In this case, I want to say I'm not going to do a discounted cash flow valuation here. I find it so difficult to predict cash flows in the oil industry. So I will go into the dividend discount model. What I do believe is, and why this is a better model, we know what the dividends are. We know what kind of discount rate we want. So let's say return on investment for us. But we can also kind of predict more the dividend growth rate. We know that Shell aims to grow their dividends with 4% per year. They can do that. They have a low payout ratio. ExxonMobil has frozen almost their dividends for 2 years. And if they don't increase their dividend in next quarter, they will lose their dividend aristocrat status. So this will be really a tight call going forward. So let's take those things into consideration and model what the valuation would be based on a dividend discount model. So probably good to know. I want to see from the oil majors an 8% return on my investment. I don't expect the same thing as the high-flying tech stocks, but in combination with the dividend, it would give me probably a return of 11-12% per year. So this is what I'm expecting, an 8% return. Hence, I use that as my discount rate number. From a dividend growth rate, I'm not treating all the companies the same. As I mentioned to you, ExxonMobil has not really been able to grow their dividends. I expect that they want to continue their aristocrat status. That's why I'm modeling a 2.5% going forward. Chevron has a slightly better balance sheet. That's why I'm saying 3%. But again, they are the full payout ratio. For both these companies, keeping the dividends at the same level is of utmost importance from a shareholder point of view. For Shell, I expect a 4% increase. TotalEnergies, although they could increase more, I expect 2%. Simply, they are having more focus than Shell currently on the transition into renewable energies. So I don't expect them to grow the dividends a lot in the upcoming years. BP as well, I expect a 2% forward. They have burned themselves several times at the moment. I find the company not really being reliable, looking at what all happened after BP Horizon, the oil explosion at that time. So I'm also modeling with a 2% here. So the outcome of that is that the dividend discount model says that the companies currently most of them look attractively valued, except BP. BP in this model is overvalued, but as you can see, TotalEnergies and Royal Dutch Shell provide the best valuation at the moment. If you find dividend growth important, then probably Shell is the winner here. But I would also say that ExxonMobil and Chevron have still some valuation. Having said that, I actually like Chevron and Shell the most of these five, because Chevron has such a clean balance sheet, still enough oil going forward. There are some, they have had a lot of capex in the past. I actually expect their capex to decline, and that's also what they mentioned in their reports. So I actually think there's more, free cash flow coming up going forward, which will allow them to grow the dividends. So having said that, you get these companies now at these yields. TotalEnergies has the highest yield. So if you doubt about Royal Dutch Shell versus TotalEnergies, it's really a question. Do you want two questions actually? If you want to bet more on the renewable energies, and the company that's more aggressive here is TotalEnergies. If you want to have more dividend growth going forward and potential, then probably Shell is the better choice. If I would look at ExxonMobil and Chevron, I would personally probably go more for Chevron. I like their metrics better, the debt level better, and their forward look better. BP I'm generally ignoring because their instability over the last years. Having said that, this is my comparison of the big five oil majors. I definitely think that oil is back. These Q2 earnings were really great. I don't see the oil price declining so much anymore, provided that we don't get a new financial recession, or that anything else happens to the system, like what Saudi Arabia did in 2016. I think now is the time for them to clean up the balance sheets, and they have been doing that. Now is the time also to really start investing into renewables more, if you're not in denial. And in my opinion, ExxonMobil is still in denial, but we will see what will happen with the 3 new additional board members, whether it will change anything going forward. To me, these companies are like tobacco stocks. They are really not popular anymore in the investment community, like tobacco stocks. But they can be really nice cigar butts and still make you really wealthy going forward, especially if you take the dividends and reinvest them elsewhere. Thank you for being here with me today. This was Sunday with EDGI. I'm back after a 2-month holiday break, which I really needed after the pandemic, but expect a video upcoming again every Sunday from me. Enjoy your week. Cheers.